Hello, I'm John Kreitler. Welcome to This Week in the Markets. On Wednesday, the Federal Reserve kept the federal funds rate at 5.5%. Chair Powell, in his prepared remarks and during questions and answers in the press conference, talked about the idea that the Federal Reserve's job is not done. Inflation is not down to 2%. Every meeting is live, meaning that they could raise rates on any meeting going forward. However, he talked about the idea that since their last rate hike in July, that inflation has been coming down, economy has stayed resilient, unemployment still stays low, but he also added the fact that financial conditions have tightened somewhat. The 10 and 30-year Treasury, the long end of the yield curve, has risen over the last 2 months, therefore tightening conditions, allowing the Federal Reserve some patience, some leeway to see how things progress with the lagged effects from its prior rate hikes. Bond market rallied. The 2-year Treasury went below 5%, the 10-year down to 4.75%. An inverted yield curve, however, a narrowed inverted yield curve. For its part, the stock market indexes also rallied up to their 200-day moving averages, awaiting further earnings and other economic reports. One thing I continue to look at is the Japanese yen. The Bank of Japan this week lifted its yield control, allowing their 10-year JGB, their bond de facto, to rise over 1%. That further weakened the yen relative to the US dollar. There might be ramifications over the next couple of weeks in case the Bank of Japan needs to protect and look to strengthen the yen through the finance ministry. By doing that, they might be selling treasuries, and that would create some sort of ripple effect in our financial markets. That does remain to be seen. Thank you for watching This Week in the Markets. I'm John Kreitler. Have a great week.